We'll keep that thread going of innovation with Scott McIntyre, Matt Venturi, and Andrew Stephenson talking about crowdfunding and adjacent innovation. And by the way, Scott is a 10-year chair of the board of CfPA, so he's been driving innovation and also with his WEconomy nonprofit.
Thank you, Vince. I'm going to pull up my notes because we have a lot to talk about, and I may talk fast, so if I am, just tell me to slow it down. So hello, everyone. My name is Scott McIntyre. I'm currently vice chair of the CfPA and the only founding member of the CfPA still here. Although one other of our sponsors, Brian Korn, is in the house from Mannett, Phelps, and Phillips. He's also one of the legacy members of our board. So I just want to thank everyone for showing up for this old guy to talk about new stuff. So here we go. As much as it's been a profound pleasure to help democratize investment for the 90% of Americans who were previously unable to invest in equities, as a side note, I'm also founder of WEconomy.us, which is another nonprofit, and we're focused on the 70% of Americans who are living paycheck to paycheck. They have no option to invest in crowdfunding, and that's a massive part of our country that I think we really need to focus on next. So that's part of why I'm here, is to also introduce that. So today, thank you again for all joining us. We've got Matt Venturi and we have Andrew Stephenson. Let me just start out by saying we've had a fair share of proposals queue up in the financial ecosystem in just the first few months of this new administration, most being framed simply as innovations. I use that quote on purpose. It's been a challenge to keep up with the pace of change, especially with a Congress that seems, unavailable. And so fortunately, the CfPA board and committees are stacked with some of the most passionate and productive people I've had the pleasure to work with over these last 13 years. And the priceless value of our nation derives from this all-volunteer organization I hope is not lost on anyone here. So before we begin, I just want to thank all of you who support our mission, and thank you to our sponsors for helping make this event possible, and thank you to my fellow volunteers who've made this organization what it is today. So joining me on this important conversation are two people I deeply respect. Matt Venturi is returning again as a sponsor of this event and our organization, and is the CEO of ClearingBid, redefining how new issue securities are broadly marketed, priced, and settled in real time, all while employing existing securities industry practices. And also joining us is Andrew Stephenson, a fellow CfPA board member and attorney at CrowdCheck Law, who ensures that compliance doesn't get lost in the rush toward innovation. So let's set the stage. We're hearing more about interoperability between private and public markets, secondary trading, ATS platforms, and blockchain-based registries. How realistic is a near future where Reg CF or Reg A securities can fluidly interact in this expanding marketplace? So let's start with what I think is a bellwether event, the recent EO, executive order directing the Department of Labor, Treasury, and the SEC to remove regulatory barriers limiting how fiduciaries invest retirement savings, including in private markets and alternative assets like crypto and real estate. Critics argue this overturns the Biden-era caution that urged extreme care with risky, illiquid assets, and is being framed more as expanding choice. But what are the real implications here? So, Matt, from your market perspective, how do you interpret this EO? Is it truly democratizing investment choice or just deregulation in disguise?
Well, thanks, Scott. It's great to be here with you all, and thanks for the opportunity. I'm here with my colleague, Cale Watson here, big, tall guy, former Navy SEAL, so don't fool with this guy. He's my wingman. Anyway, I think, candidly, the change in administration and the sentiment toward capital markets reform is a positive move. We'll talk a little bit about what we're doing later, but I see a bit of a convergence that's taking place here between what the crowdfunding, Reg CF, Reg A, and full-blown S1 registration statement, IPO opportunities exist. And it's all about wealth building. I think you hit on it, Scott, that, there's this large segment of the populace out there that don't either understand, have the opportunity, haven't had the education to be able to engage in these markets and these opportunities. And that's where it's going to start. So that's number one, is I think the education and access. And the word democratization is a bit overplayed, but I think the whole point there is as people become aware of these opportunities, and as a result, the regulators begin to be a little bit more realistic about what it's going to take to be able to create that engagement. We've got Senator Chris Dodd on the team who's been helping us with the advocacy on the Hill, which has been great. He may not be as relevant right now with the new administration, but the fact is we've got both sides of the aisle that want to see capital formation and investor protection. And the convergence of those two is really what we're looking at right now. And I think these different departments, it's kind of like Wall Street. Wall Street's silos, and every facet of Wall Street has its own constituent. And unfortunately, there's conflicts among all of them. And I think the same thing goes with the regulatory bodies, is that they have, different constituents they're trying to appeal to, but at the same time, there's a common goal. We got to make sure that common goal resonates and that it is broadly recognized and realized. And that's, at the end of the day, going to create the wealth building opportunities and that truly can kind of get back to the American dream. So it's up to them to do it, but I think it's incumbent upon us to be out there and helping to educate them on it.
That's great. Thank you. Andrew, does the Employee Retirement Income Security Act, the ERISA, still offer real protection here? Or are we shifting to a caveat emptor model under this administration?
Well, I think ERISA is a very complicated area of law, and it's something that plan sponsors, and first to understand who that is applying. ERISA is, it applies to funds, plan sponsors who have holding assets for retirement funds, for healthcare funds, and so they're all subject to specific rules. But the most challenging one, the one that they get the most sort of litigation and enforcement, is things about applying the fiduciary duties. Every plan sponsor in ERISA has a fiduciary duty to all the investors, all the members of that plan. And so as it stands, actually, ERISA plans could invest in private companies, could invest in Reg CF, but in their interpretation and in their understanding of the law and their fiduciary duties, because remember, these are funds that are they're not just taking money in to hold, they also have to pay out, and they're regularly paying out for retirement as people retire, as people use health care plans for expenses. And so with their understanding fiduciary duties, they need something that they can liquidate quickly if needed. They're going to, but a proper balance is going to have some long term, but they also need to be able to liquidate. So the focus then becomes public markets. And so what we're seeing then in the August 7th executive order, it's telling you democratizing access to alternative investments. That's kind of speaking our language. It's coming. It seems like it's coming right at us, but it's really about it. But it just shows the kind of brokenness in markets, that there's so much more going on in private. And I think the SEC, when they first did Regulation D, they saw it more as a punitive measure for companies. Hey, if you don't want to comply with the disclosure requirements, you're limited to who you can sell to. But over time, it's really become punitive on investors, that if you're not accredited, you don't have access to these opportunities. Yes, they're going to be riskier. You don't have all the disclosures, but that's where the money went, and so companies don't need to go public. So it's kind of so when those plans, but those ERISA plans, just they don't feel comfortable with putting money in. I think inside the CfPA, we're going to have to sort of pay attention to the rulemakings and how they come through, and sort of kind of be on the advocacy side of making sure that we submit something, have some sort of voice in the process. But if we can get some sort of statement in the rulemaking that identifies that here's how a plan could satisfy their fiduciary duties or invest when the plan invests into something Reg CF, potentially, or Reg A, that could open up possibilities. Even just a fraction of a percent. It's a $14 trillion market. So a fraction of a percent could dramatically change what we're seeing in the crowdfunding space. So yeah, so it's it's a matter. All comes down to fiduciary duty. So I think so it's not going to be caveat emptor, because these plans have deep pockets. They get sued a lot, and that's where the enforcement typically is. So they need to know that they can do what they're doing and still satisfy their fiduciary duties.
A great answer, actually. I think there's two themes that came from both of you, and it seemed to me that advocating for policy change, advocating for good rulemaking, these things are done behind the scenes, and that's something that we had a great experience at just yesterday on the Hill. And holding these politicians who love to claim that it's all about job creation and I'm representing my constituents, it's a lot of lip service sometimes when you get right down to it. So holding them to account is really a critical function of the CfPA. And I have to say, having been here since day one, we've never had a more accomplished, more forceful, more deliberate body of leadership than we have right now. And I am beyond honored to just be part of the team that is assembled recently. So I hope that's evident from some of the contributions that you're hearing today. One quick question on that one, Matt. I don't know if you want to chime in, or Andrew. We've even seen a bill recently cleverly titled bill, the Retirement Investment Choice Act. It's a clever name, but does it actually safeguard worker savings? Do you have any thoughts on that one, Andrew?
Which bill is that one?
It's the Retirement Investment Choice Act. It's pretty fresh, so I'm not.
Oh, is that, so is that the one? Yeah. Yeah. Is that the one that just codifies the executive order?
Yeah.
Is that, okay. Yeah. So same idea. So it's, the executive order is saying, yeah, hey, Department of Labor, do this rulemaking, work with the SEC, get it done. I think that bill is really just saying, hey, now we're going to say, from the point of view of Congress, we're going to make it statute that Department of Labor, you have to do this. But a lot of the timing is sort of kind of been thrown off by the shutdown, and they haven't yet posted any information about the rulemaking process. It will need to go through. Department of Labor has different ways that they handle ERISA or guidance and interpretations and regulations, but it likely will have to come through a rule, which will be through the Administrative Procedures Act. There will be a notice and comment period associated with that. But it's likely that they are talking to the players who have money in this space already, who have more interest that they know of. So we just have to pay attention and try to get our voice heard when we can.
It takes people on the street, like who we have on the board, of course, and those who live in Washington, D.C., to see through these cleverly named acts to really find out if it's going to make a difference. Do you have something to add?
Yeah, real quick. So, usual customary way, Wall Street's ahead of it, but Larry Fink's letter to shareholders was the democratization of investing. And this whole, getting back to Andrew's point, qualified plans have been sacrosanct. You look at how pension funds are managed, it's all match funding liabilities with assets, et cetera. But you're going down to the private markets, and one thing I beg to differ is that there's not going to be a lot of liquidity. They profess there's going to be liquidity in this market. There's not. But they're saying, look, you get higher returns in exchange for it. You don't need to necessarily get your money out of it. But it, with all due respect, it's a bit of a money grab with additional fees, and they see it as a ripe market. $13.5 trillion that BlackRock's got to keep growing. And so this is the next frontier, and we better pay attention to it because we'll all be impacted in a positive or negative way. But I think it can be positive if, for example, from the grassroots efforts here, you look at the community sponsorship and what the theory and philosophy is here. This is a really, really important message to get across, and the regulators have to hear it. And I think you're doing a great job doing it.
And that's a perfect segue, actually, because while retirement assets now estimated, depending on who you ask, between $9 and $12 trillion, may be the biggest pool of untapped capital we've seen in our lifetimes, right? And the innovations we're talking about, around tokens and digital assets are perhaps the most understood. So let's move into this space and mention that earlier this year, Republic announced plans to use Reg CF exemptions to issue so-called mirror tokens, essentially equity securities claiming to match performance of not yet public companies. It sounds good, and it's all good until you kind of get into the weeds of it. So the CfPA voiced a strong concern to this development, not to mirror tokens themselves, but to how they were being issued. And that was an issue. So I'm glad to see that the offering was paused, and yet they continued to collect indications of interest. So they are still going to move forward doing it, and we anticipate that's going to be the case. So, Andrew, for those less familiar, what exactly is a mirror token, and why does it raise red flags?
Well, so the mirror tokens are kind of speak to is also this sort of bifurcation and brokenness between sort of the private markets and sort of public offerings of securities, which can include Reg CF and Reg A. And so the mirror tokens are kind of a kludgy tool that sort of kind of packages an elegant solution to give investors access to private deals. And the structure is actually it's an unsecured debt note issued by Republic X, so an affiliate of the Republic platform. That says that we're setting value that sort of recent private markets and public reporting on the public reporting that exists from news outlets, countries, whatever, on these deals, values it at about this, which would put a share price at this level. So when an exit event occurs, if it's above that price, you get a return. If it's below that price, you will proportionally take a hit. Yeah, but you still don't have. But for investors, you still don't have the relevant institution is that private company. That's what's going to determine if that investor is going to make a return or not. And that's where there isn't sufficient disclosure for investors that would be curious about purchasing a mirror token to really understand the risks and the investment opportunity, because all they get is what the mirror token is telling, is what they hear from the mirror token, plus whatever public reporting came out in the news about the underlying company. But it's not enough to really make an informed investment decision.
So do you think the SEC is going to step in and enforce
Well,
existing regs?
I think it has. I mean, we've seen it already. Republic went out and said, "Hey, we want to do this under Reg CF," and right now we're just in testing the waters period, collecting interest. But they've seemed to abandon that. Now there's just Reg D that they're doing it for. So I think they've probably heard from somebody about it.
You know, I give Republic credit for being innovative and smarter than your average bear when it comes to product innovation. But, you know, this is kind of a continuation of what we're seeing in Silicon Valley because, you know, you got the SpaceXs, you got the Databricks, you got the Stripes, and people want a piece of these high visible companies. And so what's happening is you have folks like Zimbada, which is Joe Lonsdale's firm, his family office company, and they're setting up special purpose vehicles to then go out and make investments in these private companies, and they charge a fee for it. So they become a registered investment advisor in order to get those fees. Now, you have no collateral, you have no governance, you have no controls. It's a wing and a prayer because those issuers that want to keep the capital stack or a number of investors in their capital structure down, and so it's a special purpose vehicle, but they're not commissioned and they're not blessed by these companies. So there's a real kind of conflict and dynamic that takes place there. One, and number two, you really don't have anything at the end of the day. So I think this is just another way to say, hey, we want to monetize these types of, quote, tokenize these securities, but you really have to look through to see what you have. And if there's no reps, there's no warranties, there's no governance, there's no assets, no collateral, you know, that's telling you something. So just wake up when it comes to this.
It's the impatience with the retail investor to want to get a piece of a private company that's not yet publicly listed, and yet these type of offerings look pretty attractive when you consider the upside. But what you don't consider is it's still a private company managing a private fund about a private company. So it's a lot of gray area there. So let's pivot to another adjacent innovation that's been gaining real traction, and one that's arguably more productive. So Securities-as-a-Service. I'll be talking to you, Matt. So despite the early promise of funding platforms emerging for any and all verticals, we've actually seen crowdfunding portals struggle to reach profitability, and now nearly all investment limited to a handful of platforms. So even as technology promises to streamline issuance, let's hear from Matt on his Securities-as-a-Service model. So Matt, ClearingBid is positioned at the intersection of traditional capital markets and digital innovation. Can you explain what a SaaS means in practice and how it's changing the way issuers access investors?
Okay, well, thanks, Guy. We won't make it a long commercial, but SaaS is, we just recently got the trademark rights to Securities-as-a-Service. No one ever had it. So I figured, hey, look, you know, we might as well patent something that, or trademark something that has relevance to where we're going. But we're right now, our revenue model is a transaction fee-based model, which we're going to migrate toward a SaaS, Securities-as-a-Service model, once we gather more data on user preferences, behavioral patterns, and we can monetize that. Because at the end of the day, that's what it's going to be all about. So what we developed is a platform that basically democratizes the IPO process by following the same pathways as a secondary market limit order. So through your broker has to do the KYC, suitability testing, make sure there's money in your account. You put your order in just like you do today, the symbol, stock price, limit price, and number of shares. And that order gets reflected in the master order book. Everybody sees in our public portal how that price and volume is building. It's full disclosure, full transparency. And each broker gets paid at the end of the day for every order that gets filled because they're getting paid from the selling concession from the underwriting fee. But all brokers can participate, all investors can participate, and every single order that is in the money, in other words, it's at a bid price that's at or higher than where that IPO gets priced, is guaranteed to fill. And that fill rate is based upon the timestamp in your order. Earlier orders get a higher fill than later orders, but that's the way we're building this price discovery. So it's ubiquitous, it's seamless, it's just like the secondary market, and not only how orders get placed, but also how they get settled through DTCC in our case with a same-day cash settlement. We effectively mitigate underwriting risk. So what we're doing is we're saying, look, we want to take companies to the next level with a Form S1. We want to be able to go out to the market and broadly disseminate the information, and we want to have it totally inclusive. And through this price discovery tool that we have an algorithm and 13 patents on, we're going to open up to the masses. And it's not just retail, it's institutional, it's across the board. But we think in the spirit of capital formation and disclosure and transparency that this will be kind of the next level from Reg CF to Reg A to the Form S1, and we could talk more about it.
You discussed a lot about investor protections kind of wrapped into your model in disclosure. Let me ask, you've also described ClearingBid as helping fix a broken IPO market. how does that intersect with Reg CF and Reg A, and could crowdfund issuers eventually graduate onto your system?
Yeah, so we have one that's now a buddy who's on one of the crowdfunding platforms a second time around. He had a corporate sponsor as a lead investor originally as an investor, and now he's doing a follow-on, and he's doing it at another 50% uptick in value. And we're talking about taking them public next year. And, what we're seeing is that, on one hand, you can tap an affinity marketplace for investors, but at some time you do get sort of tapped out because there's only so many affinity investors. So this gives a company like this the ability to take the next step and more broadly market. But I think I wouldn't underestimate that affinity investor benefit. I saw on Chris's slides here, Picasso, that was one good example. They reached the 75 million limit on Reg A. They were struggling there for a while, but they've been able to go to their customer base and be able to sell this fractional high-end home ownership model. But now to get to the next level, they got to take it out to the broader market. So that's that convergence here, Scott. I think that as companies do grow, I always say deals are sold, they're not bought. So having that distributed sales force to be able to market is important. And that's the one thing that's just a challenge with the crowdfunding Reg A, is that you really don't have there's no real selling tool. And when we did our Reg A, or when we did our crowdfunding, we were very lucky because we had some sponsorship, but that catalyst goes a long way. And that's one of the things I think is missing. If there's a way to kind of plug that hole, that would be a big difference for a lot of people.
Good point. Andrew, did you have any thoughts on how this self-service model will maintain investor protection in this environment?
Right. Just anytime you have, so when you have price discovery, it means you're having, so there's transparency in information, there's an access to information. And that's what our securities laws are based on, that everybody has access to the same information. So in the IPO process, it's the monopoly prospectus. For Reg CF, we have the monopoly of the offer page. We need all investors get to go to the offering page and get the same access to all the same information as every other investor. And so with that discovery process, it should just continue. It's just utilizing new tools to bring more transparency to an offering, which is ultimately always benefits investors.
Thank you. So, of course, all this activity only matters if it's framed within a coherent policy, and that's where Andrew's experience comes in. So let's talk about policy and market outlook. Andrew, I've always appreciated your ability to clarify pretty complex ground for us on the board. So between the new executive order, mirror token proposals, and fintech platforms rewriting the playbook, what's your read on how policy and practice are evolving?
As Megan was saying earlier, there's a lot of interest on what can we do what sort of policymakers from this, what can we do for the next? What can we do to facilitate this, but still in a way that sort of protects investors. Taking a look what has been working, what hasn't been working, what is sort of unnecessary that hasn't been a benefit. And so when it gets to digital assets, I know in our experience, we've had a lot of challenges just in what is this thing? Is this equity? Is this debt? Where does it fit on the balance sheet? And I think we're going to start to get a little bit more clarity on that for issue. So in Reg CF, it's easy. You don't necessarily have to make that determination yet. It's usually when you get into Regulation A, where you're going through that SEC review, and you've got, as Marty mentioned earlier, sometimes your particular examiner is going to matter too. Does your examiner have particular bugaboo for what you're doing? And so you see deals get hung up there. But I think so. I think we're going to get a little bit more clarity, a little bit more streamlining of those things as they just get more comfortable with it. Because there is some of you have kind of two levels of what we were doing for digital securities. Or is it just a token that's just a representation of a traditional security? That's easy. We do that a lot, and on the back end, that's really already being done. So transfer agents are moving to advancing their ledger technology. So that way, to ensure sort of clearing and settlement occurs more quickly and in a streamlined fashion. But that what's being sold is still traditional security. It's just when you get into what's being sold is something different. The security itself is a digital asset. But I think we're going to start seeing it. But there are real benefits to that, especially for ones that are making payouts. So any debt instruments, things like that can be put, and it simplifies the process of putting interest payments, putting revenue share payments into a digital wallet that then that investor has immediate access to. And so and I think that's an area that because of that investor benefit, that's probably something that we'll start seeing more of, and something that the SEC and regulators will start being more accepting of.
That's an interesting point, too. And it reminds me to mention one of the things that I don't think our colleague Andy from GECA mentioned when he was on stage, and that is that most of the crowdfunding in Europe is debt-based, as we've seen, very different from the U.S. Their focus is really on that constant return, that revenue generation, that protection to a degree, because it's incremental, it's over time. You can, move those investments perhaps more in a liquid fashion. So I'm curious. Hold on, sorry. I'm curious if you see a coordinated agenda. One of the things that I found astonishing, because I assume that rules are rules and laws are laws. And when I hear that the SEC has discretion to simply publish a position or not, or to issue an issue against an issuer is a problem. And do you see an agenda emerging between the Department of Labor, Treasury, and the SEC, which are all now directed under this EO to ease the process? I mean, do you see any coordination coming down the pike?
I mean, publicly, we have not seen that yet, just because they've not gotten to sort of a really full announcement of the rule proposal and its solicitation of comments. But again, there are requirements that they have to go through. If it's going to be a rule, it does have to go through the Administrative Procedures Act. So there has to be sort of public discussion, public coordination. I'm sure what we're seeing right now, and actually what we saw even with the SEC when they were doing rules for expanding Regulation A and for regulation crowdfunding, is they still talk to industry participants, people that they believe are knowledgeable, that can give them information on what further questions to ask of the industry. So we see a lot like a discussion proposal is often a starting point where sort of industry, what do you think of this? And so yeah, and again, there's probably has been some of that already. There's still behind the scenes, but that's not yet the rules. The rules don't come until there's actually been public discussion, public comment process, public feedback, and then announcements of final rules.
Were you surprised to see the Department of Labor involved in this discussion?
No, and the Department of Labor is the main regulator for ERISA, and so if you're going to get that ERISA money into private markets, that's where you have to go.
Interesting. So Matt, with trillions sitting in retirement accounts, do you see a viable path for regulated crowdfunding to tap into that capital responsibly?
I do, because I think as a prudent measure, you want to have diversification. I think, again, this grassroots community funding effect has a lot of merit, and I think everyone can kind of relate to it. It's a question of how the pathways are established to do that. So some modest amount that's earmarked from qualified plans that have certain benefits. I mean, they're talking about the tax deductions that could take place with an investment through Reg CF. I mean, these things are important, and any kind of a incentive along with just a practical way with which to provide access is going to be, I think, well received, and it's all relative. I think the comments made about, sometimes the investors, the advisors aren't even as informed as the investors. I mean, at the end of the day, it comes down to sophistication, and within certain levels of materiality, you get concerns, but below those levels, I think access should be much broader and more ubiquitous and fairly, where people can make their own decisions.
Yeah, that's pretty good advice. I think, as an innovator and as a sponsor of the CfPA, do you have any advice on how CfPA can help ensure that innovation doesn't outpace investor protection?
Well, we've been on the hill a little bit with some of these initiatives, like trying to increase the size of Reg A to 150 million versus 75 million. One of the big things that we encountered with our first IPO candidate was we were going to do a Reg A offering, but Wall Street underwriters don't want to do them. So we migrated to an S1, and S1 requires a PCAOB, Public Company Accounting Oversight Board audit, which is a much higher stringent and standard than GAAP. And we talked to a lot of accounting firms, 30 of them, and maybe 5 of them said we're still doing PCAOB audits, but the other 25 said we're not going to do them because the SPACs, we got our head handed to us, and we had got liability exposure. So you couldn't get the accountant to do it, couldn't get Wall Street to do it on the other end. And the regulators are sitting there, twiddling their thumbs thinking that there's no problem here. Well, there's a big problem, because it's all about registration, cost, reporting requirements, and really how burdensome it is. So they got to stop and be reflective about the self-imposed restrictions that are really inhibiting the ability to truly enhance capital formation, which is one of the 3 underlying tenets of the SEC. It's investor protection, it's capital formation, and it's fair, orderly, and efficient markets. And I think what we're doing here is you've got to just keep those ideas in mind, and we're going to have the right goals ahead to strive for.
Cool. Well, I wanted to leave some time for comments, and I see we're down to about 2 minutes. So instead of talking about, or at least imagining what the next election cycle might feature in campaign promises in this space, I'm just going to open it up to Q&A. So any questions from the audience for these fine gentlemen? We've covered it all? That's good. In which case, I will say thank you, Matt and Andrew, for your insight, and thanks to everyone here for your engagement. On behalf of the CfPA, we invite you.
Thank you.
And we hope to see you all at the CfPA and on our various media channels continuing this engagement. Thank you all.